the banks that deserve and should get bailed out will get bailed out. The ones that are making poor financial decisions won't, and they'll let them fail and they'll flush them through the system, like Mike is saying. And as a result of that, as that thing happens, then the next layer of that comes in. The people or the businesses in those banks will get bailed out, or the people that were making poor business and or personal financial decisions will get flushed out as well.
All right, everybody, welcome back to the King's Table podcast. So exciting. Here we go. Another riveting week. I am your host, Ashish Nathu. I am joined by my good friends, Mike Ayala, the Sage. How are you, sir? Good to see you, man.
I'm feeling sagey.
Feeling sagey. Matty Aitchison, the hero of hospitality, the Caesar of commercial, whatever the hell. How you doing, buddy? Good to see you. And of course,
I'm doing great, baby.
I need to come up with a new intro. I think I've worn out all your names. And of course, Aaron Amuchastegui, the trend spotter himself. Good to see you guys. We have a full docket today, and we want to get into as many topics as we can. So I'm just going to get into it. Let's start with some finance, banking stuff. Lots of fun things going on there. Firstly, let's talk about Bitcoin. Bitcoin just hit, I won't say it's a record, but is kind of scratching upwards of the record. 71,000 this week. Lots of positive momentum. I mean, even the stock market's doing really well, but noteworthy. While Bitcoin's doing so well, there's an article that we talked about in the group chat about 63 banks and $517 billion of unrealized losses. Mooch, why don't you set this up for us? What is going on?
Yeah.
Should we be concerned about this, and why is it important?
Can I say something about Mooch really quick?
Yeah.
I think the trend spotter should be recognized because Jamie Dimon finally came out and said interest rates are not going down. And so I'm like, I think Aaron should take over JP Morgan Chase, the largest bank in the world, because he's been saying that for a long time. And Jamie Dimon just figured it out. So.
I finally got Jamie to listen. Jamie, if you're listening to this one, just go ahead and like and subscribe to our podcast, right, please, because we know that most of you listeners are not subscribing yet because we get way more views than we get subscribers. So Jamie, go ahead and hit the subscribe. If you reach out to me, I'll answer your call whenever you want. We're about to talk about more banks.
Don't even subscribe. Just retweet and say, these guys know what the hell they're talking about. We don't need you to even subscribe. Just retweet.
Cool. All right. Well, let's hopefully I can share that this time without losing my recording. Can you guys still hear me now? You know, along with your Bitcoin price thing, I think we should say that, you know, what's Kitty's name? What's the guy? Something Kitty?
Roaring Kitty.
Roaring Kitty. He actually made a post for the first time in forever. Like, I'm going to guess that the date was like June 2nd. Or, you know, because look at what GameStop's up 47% in the last 5 days. So don't count them out. All right, back to the news of more stuff that Jamie Dimon is going to own soon. And if he needs help with any of that, I'm going I'll stop everything. U.S. banking sector teeters, $517 billion in unrealized losses, 63 troubled institutions flagged. What does that mean? Right? Because a lot of people kind of reshared this and it's growing. So first of all, if you get flagged as a troubled institution by the FDIC, like what does that really mean? You could risk your termination of deposit insurance. So right now, that's kind of all it says. If you're flagged, the government can say we no longer have to insure your deposits if you go under, right? So now those banks are officially on watch. If they go under, the government doesn't have to back them. We've already seen, though, last year, the government's going to back more than what is backed by the FDIC deposit. So being flagged kind of means nothing. That's kind of a nothing burger, except for it is a big deal. So what are unrealized losses? So unrealized losses, the example of that is a bank gives someone a $20 million loan, and on their books, it says it's worth $20 million, right? And they haven't foreclosed on it. Right now, they get to own that note, and that note says it's a $20 million asset. Well, we know from even foreclosures that we saw yesterday and the last couple of weeks, like that $20 million note could be worth $10 million today. It could be worth $15 million today. And so if they were going to mark that properly, the bank would say, oh, it's actually worth $10 million. So we took a $10 million loss. part of why the banks aren't foreclosing on stuff right now is they don't want to show that loss yet. So, and June is like, if any foreclosures that happened yesterday is kind of the last one of the quarter. I think we're going to see a lot more foreclosures first week of July, because banks are willing to take those losses in the first month of the third quarter, because then they have ways to cook their books for the next couple. But so unrealized losses means their holdings of notes and loans they have on people are way over recognized because they're worth so much less than what they think on the books. But how big of a deal is this over the last couple of weeks? I think we're just going to keep seeing this. So they said it grew 39 billion over the previous quarter, right? So then if you look back, we're at 519 million. So that means last quarter it was, 517 billion. That means last quarter it was 480 billion, right? And maybe there was 50 banks on that list. So that list is growing, right? The list is growing of troubled banks. I think it goes into strategy when people are asking, why didn't this get foreclosed on? Why did it get foreclosed on? The only way these things won't end up creating some havoc in the long run, what it's creating right now is banks can't lend. Yep. Like those 63 banks can't give loans now. And then what could happen later is, as that gets shut down, another bank buys them, or the government just has to buy their debt.
I think this is just aligned with my thesis that the big banks are going to continue to take more market share. Mm-hmm. And I don't necessarily know if that's a bad thing. I don't know if it's a good thing. But if you go back and you look at I pulled some numbers on this because I was tracking on this a couple of days ago when I saw this stat. I was like, let's dig into the data a little bit. Let me be like Aaron and Muchastegi for a quick second and dig into the data. So from 2001 to 2023, and first off, the FDIC, they track bank failures and they provide detailed yearly summaries of our banking industry, the health, potential cracks, issues, right? Things like that. So from 2001 to 2023, here are some key data points that we can kind of wrap our head around a little bit, just to see like how severe in relative is this potentially going to be. 2008 to 2012, during and following the financial crisis, there was obviously probably the most banks that failed during that time frame. In 2008, there were 25. 2009, 140. 2010, 157, 2011, 92, 2012, 51, and then it kind of drops down after that. But 2013 to 2019, there were 8 to 18 banks per year failing. In 2020 to 2022, there were very few bank failures, 4 banks failing in 2020, 0 in 2021 and 2022. Last year, there were 5 bank failures. So if you take the 23-year period of 2001 to 2023, there's a total of 24.6 banks failing per year. So will all of those 64 banks fail? I don't know. Obviously, it depends on how the Fed plays with the rates in the market as a whole, which is kind of crazy to think about how much power the Fed has over our banking industry, right? And at the end of the day, banks go in and out of business every single year. But I think it goes back to the thesis of more and more banks are probably going to it's really the small and the regional banks. Did that article, Aaron, say what those 64 banks kind of comprise of? Are they local credit unions, small banks, regional banks?
This link doesn't say, but it talks about a study from Claros Group. I think we could probably try to pull that up. I know that there's a quick add to what's happening with the regional banks that maybe will go into some of yours. One of the problems with a lot of the regional banks, or why they're losing money, isn't these unrealized losses. They banked loans like my $2 million house loan in Austin at a 3% mortgage rate.
Yep.
And they never resold it.
Yes.
And they're holding that paper. And right now they're paying 6% for their own money. So they should have resold it. They didn't. And so they are taking losses every month, essentially I think regional banks are hurt even more because they were carrying their own paper for the longest time, and they're getting caught with their hand in the cookie jar.
Yeah, that makes total sense, right? And so I just think that a lot of those banks are falling into that category, or right, they just don't have some of the latitude and the power that some of these larger banks do to absorb some of the market shock that we've experienced over the last 18 to 24 months. Now that could self-correct in some ways, or right, they may run out of runway and leash to try and stay afloat. And therefore you're going to see other big banks. I mean, JP Morgan Chase, our man, was, salivating the second he saw Silicon Valley Bank, start to go under. And obviously they ended up winning that, a lot of that debt that they came and consolidated and or repurposed. So I think more and more of that's going to happen. And I don't know about you guys, but outside of a couple little deals here and there that, I can get good quality debt or terms from a local or a regional bank based on my deal maybe being in that market. For the most part, all of my banking for just about everything is at all the big name brand banks. And so I don't necessarily know if it's a bad thing that some of those bigger banks take more market share. Curious on your thoughts on that, though.
Mikey, what do you think?
Well, it's headlines, right? We talk about it all the time. Like, it's the information we want to see. 64 banks is like 1.4% of banks in the United States. There's like almost 5,000 banks in the United States of America.
It's irrelevant.
I don't want to say it's irrelevant, but, and I don't know if I'm the only one, but the minute I saw that headline a few days back, am I the only one that like tries to find the list of banks and see if like, because I'm working on a bank right now with a regional bank in Chicago. I'm like immediately like, is my bank on that list? Like, do I need to be, because again, it always comes back to like, how does this impact me? And when you see this headline that like 64 banks are on the verge of insolvency, like, oh my God, what does that mean for the real estate market? Like, what does that mean for my business? What does that mean for, the economy in general? Nothing. I mean, unless you're in the middle of a loan with a bank that's getting taken over and it's critical, or you're, one of the borrowers in that bank that has contributed to their insolvency, that's where it really matters. But at the end of the day, I mean, it's 1.4%. And the reason, back to what Maddie was saying too, the reason why JP Morgan loves this stuff is because it's no different than why banks love SBA loans, because they issue a loan with money that the Fed gave them, that the government gives them. It's not their money anyway. Also, it's the same freaking system that was created that allows these banks to go insolvent. It's all fake money. And so the reason why JP Morgan and all these other banks love this stuff is because the government steps in and says, hey, Silicon Valley Bank has $46.8 billion of assets, and we're going to give them to you, and we're going to guarantee 100% of the default rates. And so it's a no-lose situation.
Right.
And so unless you're actually tied up in this, or, you have a critical loan that you need to have done, which I do on some of my portfolio right now, unless I'm in the middle of that and my bank's getting taken over, it's 1.4% of banks in America.
Well, I think, but 1.4% of banks, that's not a small population of people. If it was 1.1% of Americans, that's like 30,000, 300,000 people.
Yeah, but the reality is, even if it's not a big percentage of total, it's not a big percentage of total.
It's a symptom of a bigger disease, though.
Yes.
Right. Because even the number was small back in 2009, right? So 300 banks or whatever Matt just said, or 300 or 400, but it was a symptom of the worst financial crisis ever, right? That just seemed like, so you're right in the sense, Mike, that it is a small number of banks. I think it's just a clue about the economy in general. I think maybe that's how we should use it. Instead of freaking out by the headline, you're right. The headline makes it sound like that's a big deal if the banks get taken over. That part's not. I think it's the symptom of the idea that, like, man, something's bad in our monetary system.
Well, what I was going to say back to, and I agree with that, Aaron, what I was going to say back to Ashish's comment is, 1.4% might be a big number of total banks, but the reality is there's deals within that system that are going to have challenges. When you, again, take it out to the macro perspective, there's deals within those banks that are going to have challenges. There's deals within every bank that's going to have challenges. But the reality is, like, that, if it's just one bank or it's 64 banks, they're going to get taken over by a bigger bank, and people are going to keep their jobs, and assets are going to be retaken care of. They're going to be reallocated, and the government's going to back that. And yes, some big bank's going to get bigger. But the reality at the end of the day, I mean, even just bringing it back to real estate investors, what naturally happens at periods of times like this is you've got the big operators. So if there's a loan on a bank's books that's, I mean, even if it's underwater, if a bank has written a loan for $20 million that the asset was worth 30, and now the the loan is $20 million, but maybe the property is only worth 15 or 18 million. That bank is going to go find a preferred operator that's going to say, hey, we're just going to rewrite this loan. They're not actually going to, they might take some haircut on that loan, but some other operator is going to get that property at a haircut, and the cycle is going to continue. The only bad part about this is, like, if you're the operator that your loan's getting taken, everybody else is winning in this scenario, because even the banks at the end of the day are not going to get, I'm not talking about the 1.4% of banks that are getting taken over, but it's going to flush out in the system. And there's a part of me too that keeps thinking, through all these times, we're printing on the Federal Reserve, and the Treasury is dealing with bigger issues here. And it's consumer sentiment at the end of the day. And so what do we have to do to keep people, even back to what we were talking about in the last episode? You've got 50% of people that are like, we don't want bigger banks. We don't want bigger companies. We hate capitalism. Don't bail out the banks. But in reality, at the end of the day, I feel like the government's going to keep stepping in and bailing out banks, whether it's directly bailing out the 64 banks.
They almost have to.
We
they
could
almost have
still
to
see, or whether it's bailing out those assets through giving them to other banks and backing it. Either way, it's a bailout.
I think they have no choice. Let me give you a quick story. Last week after we recorded, I had an emergency call. A friend of mine called us to his office. What does he do? Industrial waterproofing, second generation company. The bank that he has an open line, and you guys were talking a lot about real estate. So this is more of an operational business type of framework, that he had an open line of credit. He tapped into it for upwards of $3 million. The relationship regional bank that he worked with had a problem when Silicon Valley Bank went out of business. So they got caught up with that credit crunch, went out of business, were purchased by another bank, just like what we're talking about here. All these banks will get consolidated. They'll get bailed out. Their balance sheets will be held by somebody else. He's a construction company, open line of credit. For whatever reason, his company doesn't really make money. So that's a whole nother problem. But his company doesn't really make money. Okay. Meaning he hasn't run his business well. His fault, but his company hasn't been run well to actually show profitability. Okay. So the bank, new strategy says, we don't want to be in this business anymore. We no longer want to finance you, and you have 90 days to pay off this line of credit. His company doesn't make money. It's secured with his house, second generation company. He has 90 days to replace a $3 million loan, or not only is he bankrupt, but he loses everything. Okay. I think that's why this stuff is important, is that in some circumstances, yes, you can do what you can control. And so we literally walked in and said, okay, tomorrow you are cutting half your company. You are firing this, and this. You are calling your top customers and bringing in, he's running out of money in a week, and he doesn't make money. So there's a business related problem of, you need to figure out how to get your business profitable, like in 2 weeks, 3 weeks. And then you got to go shop for banks. But if you don't fix your company, you can't go shop for banks. I think in real estate, you can argue that there are certain banks that like real estate and that have diversified debt portfolios for real estate. But in operating companies, if an operating company goes out of business, the bank that finances an operating company, they may not have that appetite. So I think this is where we as business owners can get caught with our shorts down when we have lines of credit or debt financing on equipment, and a bank says, sorry, dude, we can't finance anymore, calling your loan.
Yeah, I think though, to the point of having some personal and financial accountability to the decisions you're making.
Oh, of course.
Right. The government.
That's why I said leave that aside.
Yeah, but
he's
but
an
I'm
idiot.
Right. So I'm just saying, to your point, the banks that deserve and should get bailed out will get bailed out. Yeah. The ones that are making poor financial decisions won't, and they'll let them fail, and they'll flush them through the system, like Mike is saying. And as a result of that, right, as that thing happens, then the next layer of that comes in. The people or the businesses in those banks will get bailed out, or the people that were making poor business and or personal financial decisions will get flushed out as well. So I think this is just par for the course in how our banking industry and system has worked for many decades and will continue to work going forward. and they'll backstop what needs to get backstopped, and they'll hold people accountable or businesses accountable to the bad decisions, and they won't get backstopped. And that's just part of this process, in my opinion.
If you look at GE, and I think just bringing a different correlation into it, and agree with you 100%, Matt. If you look at GE, their philosophy had always been every year, the bottom 20%, they replace them. That's how they kept their organization healthy. So it's no different. And again, I'm not saying that it's not sad, because there are businesses and there are real estate investors, and there's, people out there that maybe are not running a good business or didn't catch things soon enough, or timing of the market caught them. They didn't see something coming. Nobody saw interest rates dropping. So is it going to hurt? And I think the point that you were making, Ash, is like everyday people get hurt during these times.
Yeah, sometimes.
Yeah, and that is sad. But I think what Maddie was talking about is like it's flushing. I heard a pastor one time say every healthy body has a bowel movement, and he was justifying,
capitalism works.
He was justifying half of his church leaving, but every healthy body has a bowel movement. And I was like, but again, if the bottom 1.4% of banks need to go away, they're not going to fully go away. They're just going to get restructured. And one last thing. So back to what I was saying with and I was talking about Ken McElroy, like he makes a ton of money in the downtime because banks and private equity groups actually come to him and say, hey, we want to give you our properties. And so you take a world-class operator, and the banks take these properties back, or businesses in your case, and then they give the assets over to someone else that's actually going to go do well with them.
Yeah.
Well, spot on. I mean, when you on the operating side, first question is, why does this business still make sense? Maybe it should be shut down if you cannot figure out how to be profitable. And then number two is there an acquisition opportunity here for somebody to buy this on pennies on the dollar and fix it? So same on both sides.
And they probably have a bank that will fund that.
Yeah, absolutely. Capitalism works. Speaking of correct capitalism and efficient markets, BlackRock and Citadel are backing a Texas stock exchange in challenge to the New York Stock Exchange. BlackRock Citadel investors are backing an upstart in the Texas Stock Exchange, laying down a challenge to New York Stock and NASDAQ. Potential boost for the state trying to grab more for financial services industry. They've raised over $120 million. Why is this important? What do you think about this, guys? I don't know who put this in the chat, but
I did. But let's hear from Mooch because he's got to go.
Yeah, I thought it was really interesting when I read it. I saw this come through on the Bloomberg email today too, and I thought it was cool that you picked it up and threw it in the chat, Mike. And I wish I could. I'm gonna have to. I look forward to listening to the recording of the rest of this as you guys hit on this. So like the New York Stock Exchange or NASDAQ. So I don't understand enough about stocks to understand why some stuff is picked for NASDAQ and why some stuff isn't, and why some stuff is New York Stock Exchange and why others get traded on other platforms. But the point of what I read about having a Texas Stock Exchange, one is, Texas and California are the two behemoths of the U.S. Economic deal. Two, Texas probably wants to be ready for that civil war and to be able to have their own stock exchange that they're in full control of if they decide to recede from the union. Don't use that quote. In reality, that is me making a joke, people. But hey, if I could put on one of our tinfoil hats and maybe that's part of it. But the idea is to just have healthy competition. I think part of the argument was the New York Stock Exchange has too much power and control over which stocks get to get traded, which stocks get to get advertised in exchange. It makes certain stocks trade at higher levels and higher percentages than they would if there was healthy competition. And so that's what I read about the Texas Stock Exchange coming out. I think it's cool. I'd be curious to learn more. There's plenty. Most people don't understand. There's tons of stocks that are traded that aren't on an exchange like that. It's kind of similar to like when Bitcoin first get passed around. Mechanisms had to come for people to be able to trade it. But I do think they're going to try to be a competitor, but also get some stocks that are currently only traded on the New York Stock Exchange to instead get traded on the Texas Stock Exchange, be centered in northern Texas, I think in Arlington, which is part of Dallas. I think that would be fascinating, and especially because I live in Texas. I love the idea and the concept of it. So for you guys and the listeners, it was awesome getting to chat with you today. I'm sorry that I've got to
See you, brother.
run and miss the rest of it, but I can't wait to hear this recording, see how you guys did, and I'll talk to y'all later.
See you, buddy. Mikey?
You know what I think is really, here, I'm going to share this. What I think is really interesting about this whole article, there's a couple things in there that it talks in the article. I couldn't pull it up, but it talks in the article about how there's a lot of companies that have a desire to relocate to the Lone Star State. Yes. And that's not new news, right? There's companies everywhere that are relocating. What I think and find really interesting, and if you go back to our last episode and listen to our whole conversation about, states, it's no longer about what country you live in, it's what state. And when you look at everything that's going on right now, and I mentioned this in the last episode, how many people are saying, I will never do business in the state of New York because they're concerned about red tape and, the government there and everything that's going on in states like New York. And there's another point in this article that talks about, let me just pull this up without sharing it. Sorry, give me just one sec here. It talks about how there's a lot of international money that is looking for investment in the United States, but foreign governments are concerned about New York regulation and the policies that are going on there. So I think this just further reinforces. One of the articles that I read on this was it had a slant that, Texas was looking to grab the money and bring it to the Lone Star State. Well, there's probably some truth to that. And to compete with the stock exchange, well, why wouldn't you want that? Every state wants that. But that was a spin on it. If you look at the reality behind this, I think it's that companies, not only in America, but companies internationally, if they're going to put their money into a publicly traded company, they want to have that, because when it's based in the New York Stock Exchange, you're literally investing through that and you follow those rules and regulations. And so when Texas starts its own stock exchange, it's going to be governed by the rules of Texas and the thinking of Texas.
Yes.
And all of that. And so I think this just shows a bigger move that, again, I think we're going to see more and more and more over the next 1 year, 5 years, 10 years. People want to do businesses in states that are business friendly. And not only people in the United States of America, but international governments, international people that want to know that when they invest their money in the United States of America, they're going to have the best chance possible of that money being protected. And where can that be done? Texas.
Yep, I agree. You're spot on. I don't think I have too much to add to that, because that ultimately was the same stance and perspective I was taking from this, going back to last week's conversation of where you raise your family, where you invest in, where you start your business. That matters. Why is BlackRock behind this? Well, BlackRock wants to protect their money. And when you see a lot of the legislation, the policy, how things have played out in New York State specifically, in a lot of other blue states, we've seen a lot of businesses, a lot of taxes, a lot of money funnel out of those states into other states like the Texases, like the Floridas, like the ones that are a little bit more pro-business, right? And so I think when you look at BlackRock's financial position in the world, this is also another hedge of protecting against what they've already got invested in the New York Stock Exchange, and also saying if things continue to go bad there, we've got solid ground, foundation, and footing for being first in over here. And I think that's going to be something that I believe more and more people are starting to check their emotions at the door, and they're betting with their pocketbook. And therefore, we might see more businesses, more investments, not just domestically, but like you said, Mike, internationally, start to look at exchanges that feel more aligned with where they think their dollars can do best without a lot of the BS and the red tape that goes along with it in some of these states that have shown to be more problematic when it comes to policy. And those generally have been blue states.
I want to pivot. Next topic. There's an article in the Wall Street Journal here. I'm going to share it here. We've been talking a lot about finance. Stock market's better than it's ever been. Unemployment's super low. Real estate prices are high. Are we at the top? The economy is doing great. Why should the Fed reduce interest rates? Blah, blah, blah. I thought this was a really interesting article about how Americans have more investment income than they've ever had. It talks about how basically inflation and the increases of asset prices, specifically in stocks and real estate, are causing people to have a lot more income. And so even though job wages are probably not increasing as much as inflation is increasing, people have more, I don't know if you want to call it passive or active, either way, but their portfolios are growing, therefore giving them more income. And how much of this is translating, these additional earnings is translating into spending and increased amounts of debt. I thought this was a super interesting article. What do you guys think about this? Do you see this as a component, a trend? Obviously, the stock market is as high as it's ever been, and we just talked about Bitcoin earlier. You can see here household wealth gains by income percentage. Pretty much every single category over the last 4 years is upwards of 30 to 45% wealthier today than it was in the last 4 years.
Yep. I mean, I think a component of that is the amount of printing and dollars that have been injected into the economy, which obviously a lot of that has been either spent on consumer goods and services, or a lot of it intelligently, and I love to see it, has been invested. But just as those investments can go up and that income can increase, it can also go the complete opposite direction if and when there's a correction or a crash. And so if people, just because they've increased their income, aren't allocating that spending accordingly, or, saving it or investing it wisely, and it's going to a lot of goods and services that we've seen a lot of inflation, experienced in, I think that can also, as it has gone up, swing the pendulum, swing back in another direction and go in a much negative direction that could be much more problematic for people in the future if they're not thinking or planning accordingly in that way. I know a lot of people that have seen their income jump, and their lifestyles and their spending have jumped right along with it. And I think we've all seen historically over, crashes and corrections, people that have done that end up regretting it and say, oh, I wish I wouldn't have done this. And man, I lost everything because I did that. Right. So I don't think every single person that has seen their wealth increase or their income increase has increased their financial acumen or disciplines around how they're utilizing that wealth growth or income growth. And it could end up, I'm not saying it will, but it could end up being something that comes to bite them in the butt in the future.
So one of the interesting things here, and again, every time you see an article like this, it's just like, okay, how is this thing skewed? When you showed that chart of the wealth increase, this is some interesting data here right off of the St. Louis Fed's website. How much wealth inequality is there in the U.S.? The top 10% of households by wealth had 6.7 million on average. As a group, they held 66.9% of the total household wealth. The bottom 50% of households by wealth had 50,000 on average. So the reason why I kind of point that out and bring
disparity.
It up. Well, and you look at, again, this is like clickbait stuff, right? It's like,
right.
If you read the Wall Street Journal article, it's like Americans are doing great. A few weeks back, I was looking at, because we run ads for accredited investors, and, I've got like 1,400 people that have hit our list in the last like 5 months or whatever. And I was like, man, at what point in time does this like, do I run out of accredited investors? And so I went and just Googled, because, I'm thinking from a scarcity standpoint, I'm like, man, have I hit all the accredited investors? There's 22 million accredited investors in the United States of America. And I'm sitting over here thinking that because
I'm running out.
Yeah, I've hit, 1,200 of them. It's not even 1%. I'm not even I haven't even hit 0.1% of the accredited investors in the United States of America. And so bringing it back to what you're talking about, Ashish, it's like, yeah, I think generally speaking, not generally speaking, I think that the average household wealth has gone up, but 10% of the population has 66% of the wealth. And back to what we were talking about in the previous episode with like mindset and, the average American is not feeling what the Wall Street Journal was talking about. Like, my wealth has gone up. And so generally, I think people are hurting, yet the wealthy are getting wealthier. And I'll pull this together from my viewpoint. My takeaway on this is I need to make sure that I'm focusing on me and the circle of influence that I can impact, because I want to be in the 10% that has 66%. I don't want to be in the 90% that, and actually you can dig into this on the St. Louis Fed. It goes down and down and down. Like the bottom 50% has like 1.4% or 1.2% of the wealth. So it astronomically, the top 10% has 66%, but then the next 10% has like 35% of the wealth. So like 90% of the wealth in the United States of America is held by like 18% of Americans.
Do you know how you guarantee not being in that 10%, Mikey?
Tell me.
You don't listen to this podcast.
That's good.
At least if you're listening, there's a chance that you're in the right conversations. Okay. Last topic, super fun. Let's be a little playful. I want to talk about Caitlin Clark. I don't know if you guys have been following this chick. She is blowing up. I want to share this article, which I think shares some of the relevancy of why she is important. If you don't know who this is, listener, that's okay. Caitlin Clark is like the new unicorn. That's what she looks like right there. She's the NCAA's new unicorn. She just got drafted to the WNBA to play for, who does she play for? Indiana Fever, I think.
Yep.
So a 21, 22-year-old girl just absolutely blowing it up. So let me read some of these stats. She had 18.9 million viewers watching her last game in the NCAA championship. The overall ticket price for a Final Four game went up 250% during her tenure. Unfortunately, she lost the NCAA championship in her last year, but the ticket price doubled 2.5x in terms of pricing. Okay. I want to show you some stats with this girl too. You can see her overall points compared to the NCAA's best scorers. She is, what is this? Maybe 10% more than the last person, which was in 1970 than 1981. So she's like far superior than most people that ever played basketball. Pretty amazing how that's happening. And then when you look at her assists, same thing, like just really up here. And everybody just wants to watch her. I think there was a hard foul. There was an article that came out last week or a couple days ago, right? That she got totally destroyed with a hard foul. So she just gets so much attention. I have not ever watched any of her games, but man, she's getting so much attention. You guys watch this? Are you guys following?
Oh yeah, I've been following it very closely.
Yeah, tell us, Maddie, what's going on? Like, why is she getting so much attraction? Is it really because she's a great scorer? What is it about her energy that is just rallying the country around not only women's basketball but around women's sports? Go.
Yeah, I mean, I think it was a combination of the last NCAA women's class that came out between Angel Reese and her, and Cardozo, and there was just some badass girls coming out that for the level of what most people were seeing in women's basketball, they took it to a whole nother level. And then there was this level of drama and this competitive spirit that also kind of took things to the next level, that their play on the court was great and elevated. But then there was this coverage, and then there was this drama, and there was this competitive, fiery spirit that all of them were kind of engaging and interacting with online, that kind of, compounded with their game as well. And then obviously as she's come into the WNBA, I mean, she's gotten, I think, a $20 million endorsement from Gatorade, a 10 plus or $20+ million endorsement. I think she entered the WNBA with like $50 million worth of endorsements from Nike and collectively all the different sponsors, because of the viewership that she was getting and demanding, at her games. The WNBA has really kind of elevated in a way that, whether it was her, Angel Reese, some of the other gals, a combination of all of them, the WNBA has really taken that next step up. And I think it's in concert with the NBA really trying to lift up the women's sport a little bit more as well, to where we're seeing, they got chartered flights now. They're starting to see some exciting things happen in the WNBA. I will say this, I'm a girl dad. I've got, a third on the way. watching those NBA games is pretty damn boring. In a lot of ways, I've seen some of their highlight tapes and reels, and it's like we're watching them do layups. And she's created this level of excitement where she's pulling Steph Curry level threes and making it look easy. And now she's kind of got this target on her back as the number one player. And a lot of people are really in the media going after her. The players are kind of going after her. And so there's this weird kind of dynamic. People are talking about white privilege. People are talking about the fact that she's not lesbian. There's a lot of weird dynamics in the conversation around her. But that being said, I will just say that, these women are playing at the highest level of the sport. And anytime you're a first round draft pick and or the number one pick of the first round, you're going to have a target on your back. And then if you're coming in with the level of accolades and attention and hype that she's got, you're really going to have a target on your back. These girls are competitive. They're fiery. They want to win. They want to, get after each other. And so I think, some of the cheap shots or the fouls that people are saying, are dirty and they're just because it's Caitlin Clark. I'm like, at the end of the day, you could go back and look at a lot of the first round or first picks of the draft in the WNBA, and all those women had a target on their back, and all those women that were coming in wanted to show them what's up. And so I think this is just part of the process, but of course they're hyping it up. It's in the headlines. They're making it bigger than maybe some of those issues are, and I love it.
It's good. Mikey, bring us home.
Does she play baseball?
Shut up. This is all, it's very good for women's sports, I think. I think you said a lot of the right things, Manny.
Yeah, I have nothing to add. It's pretty phenomenal to watch.
It's pretty phenomenal. There's a really great Netflix documentary on US, I think it's US soccer, the US soccer team. And they talk a lot about the things. And when you have these sort of pioneers, I wouldn't say Caitlin Clark is the only pioneer of women's basketball, but when you have these special people that have that much power to hold the sport on their shoulders, the sport just grows, especially in women's sports. And I think that's something we all can be in support of. And that documentary does a really great job of explaining how they were able to get equal pay and equal benefits and all these things. So I really encourage everyone to watch that. Good stuff, good topics. Can't wait to keep watching Caitlin Clark grow in her career. We're just at the beginning, right? So super fun. Thanks for listening, everybody, to another great episode of the King's Table Podcast. From your Kings, I am Ashish Nathu, your host, of course, the sage, Mike Ayala. See you next week, brother. Maddie Aitchison, good to see you, bro. And of course, the one and only Trend Spotter had to peace out early today, but we got some wisdom from him in our conversations as well. Lots of fun things going on in the world, as always. And the best place to listen and get a little bit smarter so you can be in the top 10% is here on the King's Table Podcast. Make sure you follow us on YouTube. Make sure you subscribe. Click that subscribe button, please, please, please. And remember to leave us comments, leave us questions. We love engaging with all of you guys. Love you. See you next time, and peace.